All right. Welcome, everybody, to Home Service Central. This is Mike Patel from Anaheim Hills, California. Welcome to my channel and my live stream, Mondays at 2 p.m. We have an exciting program today. We're going to talk about the impact of interest rate on the housing market, but more importantly, the impact of interest rate on you if you're a buyer or even if you are a seller. Because if you're a seller, you're probably thinking about buying something, or you might have a 3% interest rate and now you have to pay 6% interest rate. And if you're a buyer, you might have qualified at 4% interest rate, but now it's at 6 or 7% and you cannot qualify. So we're going to talk about interest rate. And to help me talk about this, I'm going to have a special guest, which I'll introduce in a few minutes. But I want to take another minute and thank you again for joining my channel. My name is Mike Patel. I'm in Southern California. It's very hot today. We have the Texas or Arizona weather over here today. It was 100, 105 a couple of days ago, and it's still hot. But I'm inside a room and nice and cool, so we can talk about this. So let me bring on Fidel to the stage and introduce him. Hi, Fidel. Can you hear me?
I can. Can you hear me okay, Mike?
Yes. So everybody, this is Fidel.navarrro. He is with Homeowners First. He is a lender in my office, and I'm with First Team Real Estate. And Fidel has been in the loan business for a long time. Can you take a few minutes and introduce yourself, Fidel, what you do, and where you've come from in the housing market?
Of course. So I've been in the mortgage business now just a little over 20 years. Started in April of 2004, so just a little over 20 years. Currently working with the First Team Real Estate offices. We are the preferred lender for them, and it's great to be here, and I appreciate you having me today, Mike.
Sure. Yeah, we have a lot to talk about. One of the things I want to talk about, and we go along as we go, is first of all, what's going to happen with the interest rate. Not just what's going to happen, but there's a big talk about Jerome Powell and the Feds cutting the federal funds rate and how it will affect our mortgage rates. The second thing is, how will it affect especially the first-time home buyers and buyers if it doesn't drop much. So that's what we want to talk about, amongst other things, But before we get into that, let's just talk about, I'm going to bring this chart over here. This was a chart by a National Association of Realtors. And can you see this chart, Fidel?
Yes.
It just talks about mortgage rates and the projections. Of course, projections are projections, but I want to see your personal opinion. Where do you think they'll go? Although nobody has that, spoon or the crystal ball, but where do you feel they're headed? Indications, these guys are saying it's headed down a little bit. So
it is, and it has been for a while. The last couple of months, it's been in a trajectory going down very minutely, but still in the downward direction. The Fed FUD rate, or the Fed meeting coming up, they finalize it on the 18th when they make their announcement, is not directly tied to mortgage. A lot of people believe that it's the same thing, but it really isn't. It's two separate items. It does influence the mortgage market as well, but it's not directly tied to it. But with that, I believe that if, depending on how big of a cut they make, they're speaking between 25 to 50 basis points. I think that will also affect the mortgage side, but still the projections that are on the board, I believe are correct. We're still going on the downward trend. And I think, obviously that's a favorable direction.
Right. So since you mentioned the federal funds rate, could you just briefly explain, I know they're different, but how will a typical buyer or seller know the difference between them, and what affects when the federal fund rates go down? What are the chances that the mortgage will go down, and what affects or not affects it? Can you give a brief description on that?
The Fed fund rates is based on economic data. So they determine, whether we're going to go into, hopefully not into a recession. They help with inflation, right, to control inflation. But as far as mortgages, the mortgages are based off the mortgage-backed securities. It's a different measurement, I guess. But it still does get affected by the Fed fund rate. So
Mhm.
with them lowering that rate, as they're seeing the inflation rate coming down closer to 2%, then the Fed will start easing off on the interest rates, helping stimulate economy. So that's why they have the whole is it going to be a soft landing, right? They
Right.
didn't want to hold the rates up too high so that we go into recession. So they're I think they've done a great job. I think better than most have thought, where they've held on to it and a period of time to where it makes sense to maybe drop it a little bit now.
Mhm.
But it's kind of weird how it does have an influence with mortgages, even though it's not directly tied, but it does have an influence. So we're as they drop, I think we're going to drop as well. The mortgage rates will drop
Right.
a little bit as well.
Yeah, there's a good chance, and well, at least everybody's hoping, and I personally is hoping that it'll drop. Not only for me, because I'm not going anywhere. I've been in my house for 25 years, and I'm not going anywhere. I have a 3% interest rate, so I'm not planning on selling or buying. But I know a lot of my friends and family, and even regular clients, they want to buy, but when it went up to 6.5, 6.75, close to 7, they just got kicked out of the housing market.
Right.
It has dropped since. I know it has dropped. It's under 6.5 right now, and they're willing to buy, but they're still holding on and say, hey, if it gets anywhere close to 6, we're going to jump right into it. So any prediction on if it's going to get close to 6? I don't even know what the rates are today.
Yeah, as far as the conventional financing, it's in the low 6s. FHA is in the 5s. The difference between the two is conventional financing is, even though the rate's a little bit higher than FHA, but FHA has a mortgage insurance that's a little bit more expensive than conventional financing mortgage insurance for anyone who puts down less than 20%.
Right.
But sometimes there's a big enough gap, depending on how much you're putting down, right? If you're putting less than 20% down, there's a big enough gap where it might make sense to even go FHA. At one point, it was almost a full point in rate difference to where people were saving, serious money. It was $300-400 a month by taking an FHA loan versus a conventional, even though they can qualify with conventional financing. And FHA, the difference is, they're a little more flexible. So they do carry an upfront mortgage insurance as well as the monthly mortgage insurance. But when the rate is so far apart, we just look at the bottom line, and we give the option to the client and say, look, you can save more money, even though, yes, you're paying more in mortgage insurance, but bottom line is you're saving X amount of dollars, and these are your options.
Right. Cool. Okay. Now that you mentioned the FHN, I was not going to bring this up, but what happened on August 17th, 2024 is that the whole regulation about agents showing and getting paid from the seller changed a lot. So now the burden of the commission is on the first-time home buyers or any buyers, specifically when it comes to FHA buyers, where most of the FHA buyers that I've worked with barely come up with a 3.5% down. Orange County, homes are $800, $900, $1 million. So if they have to come up with 3%, that's almost, $20,000 or $30,000, 3%.
Right.
But when it comes to the average home buyer, let's say 400,000 is your medium home price, how will they come up with this extra commission, or how will they handle that coming from the lender's point of view? We have our own guidelines, but if you were working with an FHA buyer and he has an obligation of 2% commission to the buyer's agent, if the seller does not pay, what's the scenario there?
Well, so far, there's been no lenders like Fannie Mae, Freddie Mac. They're not allowing the agent's commission to be rolled into the financing. So we have to get a little creative, depending on how much money we have to work with. Each client's obviously going to be different, but if they have some money to work with, if they only have, let's say, the 3% down to purchase a home, and they need to pay the buyer's agent, then maybe we can switch financing, go to maybe 100% financing. So the little bit of money they have, they can use towards the buyer's agent commission. Other options would be possibly to offer a little bit higher sales price to make up for that, and have the difference go towards the commission for the buyer's agent. So we can get a little creative if there is a little bit of money to work with. When it gets tough is when there is no money to work with. Then it unfortunately falls on the buyer agent to negotiate as best they can, I guess.
Right. Got it. Yeah, and I don't want to go into detail about the commissions and all that,
Right.
but I thought it was important to bring it out, especially for FHA buyers and VA loan is a whole new story, so we won't even go there, But let's switch some gears now. We always talk about what's going to happen coming. Fidel, what I want to talk about is how much do you think of an impact has it had on the housing, specifically for first-time home buyers or just buyers, when the rates went up from 4%, 5% to 7%, and how much impact will it be even if it drops 0.5% moving on?
Well, it did kick a fair amount of people out of the market. Obviously, everyone's different, but it does kick people out the higher the interest rates go. My thought is if you can qualify to purchase a home, even though the rates may not be at the lowest point, it's still, I think, an advantage as a buyer to buy. And the reason for it is because you're in a pool of qualified buyers where someone else may not be, or at least not yet. So when you go to purchase a home and place an offer, you're competing with, let's say, 5 people. And as rates drop, that's going to increase because more people are going to be able to afford that same home. So I believe there is an advantage to buy when you can buy, not necessarily wait out the market to get to the lowest point. And, if you really can't qualify until that point, then fine. But if you can qualify now, I believe it's to your advantage to purchase now. And you always have the option of refinancing down the road and compete with less clients.
Right. Correct. Yeah, that absolutely. And, I always talk, I did so many videos and I always talk about 2 clocks. One is that you're going to have a 30-year clock, assuming you get a 30-year loan. Most loans are 30 years. So if you're going to pay for 30 years, start today. Why wait a year, 2 years? So start your clock early. But the second clock, which is more important than the first clock, is the clock of appreciation. Historically, if you look at the 40-year history of USA, historically, homes appreciate on average, of course, it's an average at 4% per year, right? It could be 2%, it could be 8%. Yes, sometimes like in 2008, they went down, but an average is 4%. So number one, the first clock, why don't you start paying now, get it over with early, your first 30-year clock. And the second clock is if you buy a house for $400,000 and after 30 years, it's gone up 4% every year, you're going to quadruple or triple that home. I just read a report yesterday, and I wish I could bring it up. There's a report out that in the last 30 years, in fact, I just read the report today. In the last 5 years, homes have appreciated almost 52%. But in the last 31 years, they've appreciated 318%, which means they've doubled not double, but they've gone up 100% every year.
Yeah, it's definitely an advantage to buy as soon as possible. There's always the cost of waiting. In the lending side, I do have clients that say, maybe now is not the right time for me. Even though they do qualify today, they're like, well, I think I might want to buy a little bit more home. I'm going to save another $10,000. And for whatever reason, it's always $10,000, right? But so I ask them, okay, how long is it going to take you to save that $10,000? And they're like, it's going to be about 6 months to a year. Say, okay, well, that same house that you're looking at today that you can buy today is going to go up more than $10,000 in value in that 6 months to a year for sure. And you're going to lose out on that home. You're going to have more money to come in, and you're going to lose out on the appreciation that you would have made starting today.
Right.
Or when you bought the home.
Right. Exactly. Right. So I'm going to put up a chart here. Let me put this chart up talking about, people who waited, let's say last year they waited, or 2 years, since the last 2 years, a lot of the buyers, and I know I have personal buyers who have been waiting and waiting and waiting. So if you look at this chart, it says home price are forecast to rise. Now, this is talking 2025. So for the buyers who waited last year and this year, they've already gone up 4 or 5%, and now they're going to go up again anywhere from 0.3% to 4%. Of course, this is all local. So
Sure.
if there was a buyer who has been waiting for a year or 2 years and still waiting, what would you tell them knowing that the prices are going to go up? And me personally, based on the statistics, all the reports I've read, the inventory, which is very low, the demand is so high, I guarantee to myself and say to myself, the prices are going to go up for sure versus
No,
coming down.
absolutely.
Right.
I agree.
So how would you not convince a buyer, because you can't convince a buyer, what would you tell the buyers that, hey, this is the right time to buy, don't worry about the price?
Well, we use charts like this, or we can use historical charts that show what the home, cost 10 years ago, or even a lot of times I'll use, for example, I'll ask about their parents. It's like, hey, your parents bought their house for, depending on when they purchased them, right? But it could have been in the 60s or 70s. It's like, when did they buy a home, or 80s, or whenever it was? But that home has now, tripled in value.
Mm-hmm.
And it's
Right.
always, people and it's normal, especially first time home buyers, they fear the purchase. Oh, how am I going to make that payment? And I had that fear. My first home that I purchased, it probably took me a month to relax and get into it. And then after you get one under your belt, then you realize how it works, and it makes things a lot easier. But the right time to buy is always as soon as you can get in. I mean, realistically, the market is just going up. 2008 was what, I don't see that happening again. That was a lesson that we learned. And I believe that we're gonna, that will not happen again. There was a lot of things going on that shouldn't have been going on, and now are regulated. And I think that we will keep that from happening again. And since then, and even those homes that were maybe underwater at the time are now the people that hung in there have equity, and they have doubled in value. A lot of it was artificial, but now it's stable, and it's buying a home is a great investment. And I believe that when you can purchase, you should purchase, and start making, you're going to start building value in your home. It's going to start building equity as you're paying down the mortgage. You're making money both ways.
Mm-hmm.
The property's appreciating, and you're paying down your mortgage. And so
Correct.
it's a win-win.
It's totally a win-win. Let's just compare quickly what happened in 2008, because we hear it all the time. And I was there in 2008. It was devastating, not only to me as my income and my family things or whatever, but people lost homes, people got divorced, people lost cars, everything. But just want to mention a couple of things why this is different. In 2008, number one, there was tons and tons of inventory because a lot of people could not refinance. They had a lot of toxic loans. They refinanced at 1% for the first year. Then it jumped to 4% second year, to 5-6% second, third year, whatever. Very bad loans. Loans were given to anybody. There was a joke. If you have a driver's license, you got a loan. So anybody got a loan. And there was lots of inventory. Currently, there's no inventory. That's a different. And number one, since a lot of the lenders learned their lesson from 2008. And if you realize in the last 5, 6, 7 years, lenders were very strict on giving out loans. You have to have A paper or B paper, good credit score, prove your verification of employment, prove everything before they give a loan. So all the people who bought in the last 3, 4, 5, 6, 7 years are very good buyers when, in terms of the lender's point of view, your point of view, Fidel, right? You only gave loans, right? So they're not going anywhere. Not only that, the biggest difference between 2008 and right now is that, like I mentioned earlier, anybody who bought in the last 3, 4, 5 years, their homes have appreciated over 50%. And if they bought, like mine, I bought 25 years ago, I have equity double, triple, right? So there's a lot of equity in the homes currently. Even if you bought 2 years ago, in fact, I'm selling a house tomorrow. I'm writing an offer tomorrow on a house in Ontario. The lady bought the house for 1.2. It was built in 2021. She paid 1.214 for the house, and it's up for sale for 1.275 after 3 years. And the reason she's asking 1.275 is after all expenses and commissions and escrow fees and all that, she's going to break even. So she has to move due to emergency or whatever it is. But now she's able to sell, and there's no short sale, there's no bank repo, nothing. She's going to sell, get her money back. She put a good down payment, and she's going to move on to wherever she's going. So the equity that we have in the homes is going to prevent from going into foreclosures because there's plenty of equity out there.
No,
So
absolutely. You're 100% correct.
Right.
Yeah.
Right.
So that whole thing with short sales, I mean, they're really that concerned, maybe very rare cases, but for the most part, yeah, I mean, it would be a rare case for it to be a short sale.
Exactly.
Their mortgages are now, and since the '08 lesson, people are very well qualified. If you do have to go through some hoops to make sure that you are qualified for that home, and it's a good thing. We want to make sure that they can make their mortgage payment. The last thing we want is for them to lose their home. So they did toughen up the rules, and everything is verified, and people do now have a lot of equity to where, if they bought, like you said, if you bought 5-10 years ago, you've got plenty of equity. You're not gonna short sale. If something terrible happens, lose your job, something like that, then there's equity. You could sell your home and still, have a little bit of money to do whatever it is that you need to do. But yeah, it's a different time, and I think it's a good thing. Now
Good
if
thing,
you
yeah.
qualify for a home, you qualify for a home. It's
Right,
not just
exactly.
breathe on a mirror.
Right. Cool. So let's look today. Okay, so today, if I'm a buyer, hey, Fidel, what's the interest rate? Are they good? Are they bad? What can I buy? If I'm a buyer thinking, hey, let's talk about today. Where's the rates today? So,
So, and it's a tough question to ask. People ask, hey, where are the rates? Okay, well, generally speaking, okay, that's why we can get low sixes for conventional financing on 30-year fixes, a little bit lower on 15-year loans. FHA is a different animal that but allows it to get into the fives. So. But everybody's different. Everyone's case is different. To answer that question specifically for a person, that we do need a fair amount of information. There's probably about 10 things that we need to see where exactly they are, and it could be something as easy as credit. Obviously, is a factor. What type of a property is a factor? If they're buying a single family home, it's going to be less expensive because it's a lower risk than, let's say, a condo, right? If you have a condo. And you're the lender, the risk, if your neighbor's unit catches on fire and you have a common wall, then the risk is greater that your unit's going to catch fire as well, versus a single family home where there's actually a space between the two homes. The risk is less. So risk has a lot to do with lending. The higher the risk, the higher the rate. Exactly. So that goes as well as the property, the individual, and all these factors have to be taken into consideration. But generally speaking, we are in the low sixes for conventional 30-year fixes, without any points. We can go lower, but there are points you can actually buy the rate down if it makes sense. Right. In this environment, when the interest rates are going downward, it doesn't really make sense to purchase points unless you need them to qualify. So let's say without paying points, you're at 6.25, but at that point, your debt to income ratio is too high. It exceeds the maximum amount. So we maybe need to buy it an eighth, of a percent or something, and then that gets you to qualify. So in that case, yes, we do need to do what we can to get you to reach your goal or get the buyer's goal. Right. But other than that, if not, then I would say there's no need to purchase points.
Okay, cool. Well, thank you. I'm going to share I know you had sent me a link earlier. I'm going to try to see if I can put it on the screen and see if you can share the rates. Let me see. Okay, can you see that?
Yes.
Okay.
So this is a great site to take a look at. It is nationwide, but it's called mortgagenewsdaily.com. And it has a lot of great information for consumers. You can go on there and you can, just start clicking on things. It gives you definitions of mortgages, terms that are used. It's a great resource. But this shows this shows the graph, from October of 23 to September of 24, and how the interest rates have moved. Now there's 3 lines there, and we can't see the key at the bottom, but it's just 3 different entities that are describing where they feel that the rates are going. But as we can see, in general, they are going in the downward direction, and it is going to be somewhere in the low sixes.
Which is pretty good, because if you look at, let me see, September 24, they're going to go close to, 6.25. Looks like it, around that much. But if you go back a year or so, it was pretty high. It was in the high 7s. So that's quite a significant drop as far as the buyer's payment goes, and to qualify, right?
Yeah, no, I mean, at one point we hit 8, right? In October of 23, we hit,
November 23, it was almost 8%, which is, a lot of people didn't buy,
Right. It limited a lot of people from purchasing a home. And then it bounced back around in looks like we hit 7% at one point, and now we're starting to trickle down. So opportunity is there for clients that need a little bit of help.
So if I look at this chart, and I'm assuming I'm a buyer or a seller, not an agent. If I look at this chart, if I bought around here, I don't know if you can see my arrow. If I bought the house in November 23, which was 8%, or if I bought a house anywhere from April, May, June 2024, they were 7.5%. And if I'm looking at it right now at 6.25, would I be one of those buyers where I should refinance right now or should wait?
Yeah, well, it would be something that we would take a look at to see if it benefits you to refinance at this time. With the Fed meeting coming up, and if you haven't done anything to this point, it may be a good idea just to wait it out another couple of, was it a week and a half or so? And let's just see what happens. My thought is it's probably going to still, as it's still trending down, it may be better to wait a little bit as the homeowner, not necessarily as a buyer. Right. But as a current homeowner, I would say we ride it out a little bit longer and see where they're going. I mean, unless you have a specific need that you have to refinance now, but still, you're in a better position now than you were at the time of purchase.
Right. Okay, cool. Okay. And you had another slide that you want me to share. Let me share that. It's called, was this, not this one. Let's see, today's. Yeah. Let me see here. Okay.
So this kind of breaks it down a little bit easier to read than the other chart. Okay. But this is again nationwide average, and if you notice the loan amount is, you're going to see payments. It's going to show monthly payments, principal and interest underneath each example, and that's based on a loan amount of $250,000. And we can change that. You can go in. That's one of the great things about this website. You can go in and you can change it for your area. You can kind of figure out what the prices are in your area, and it gives you principal and interest. Now, it doesn't include taxes and insurance or any HOA if there is any, but it gives you an idea as to where rates are, and that's where we are. See, 6.25% on conventional financing, and this would be for conventional financing that's $766,500 or less, which is the conforming loan amount. Above that, it depending on the county. Some of them have what's called high balance, which is in between conforming loan amount and jumbo financing. And jumbo, in Southern California, or in Riverside and San Bernardino counties, they don't have high balance options. So anything above the conforming loan amount is going to be jumbo money. Okay, and jumbo money is not, it could be a good deal. It sometimes can be less expensive than the conventional, the normal conventional, depending on, once we start getting to higher loan amounts, it can be a better deal. But the one thing with jumbo financing is it requires reserves. So that means that, you have to have some money in the bank besides the money that you're using to purchase a home. So that's a different category of purchasing. But just to kind of give you an idea, so you know how jumbo works, anything under $1 million, you're going to have at least 6 months of principal, interest, taxes, and insurance, and HOA if applicable. If it's over $1 million, up to about 1.5 or 1.8, somewhere in there, you're going to be looking at about 12 months. If you start going above that, then sometimes it'll be 18 months of reserves that you have to have
Right.
To qualify for that mortgage. But now you're talking larger loan amounts.
Right. Okay. So on this example, Phil, can you take us through an example? Let's say if I was a buyer and I'm looking at your first here 30-year fixed 6.25%, how much down payment do I need over there versus if I look down on an FHA loan, 30-year FHA 5.7%, the payment is 1453. So what are the differences as far as the payment goes, and what are the differences in down payments and qualification?
So on a conventional financing offers, when things are even, conventional financing is usually less expensive in general. Okay. But when there's a big spread in rate, then we have to take that into consideration. But let's say if the rates were even, conventional is less expensive. You can come in with as little as 3% down on conventional financing. The mortgage insurance is less expensive than FHA for conventional financing. FHA is more forgivable. So if you have some credit concerns, low credit scores, maybe a bankruptcy, the time limits are shorter. So again, it's more flexible, but there's a cost for that, right? Everything's risk-based, so there is a cost for it. FHA has an upfront mortgage insurance as well as a monthly mortgage insurance, and the minimum down payment is 3.5% versus 3% for a first-time home buyer. If they're not a first-time home buyer, then conventional does require a minimum of 5% down. And the definition of a first-time home buyer is someone who has not owned a home in the last 3 years. So you can be a first-time home buyer again if let's say you sold your home for whatever reason more than 3 years ago, then you are able to purchase another home with as little as 3% down on conventional financing.
Good. Okay, I got a comment. I'm just saying hi to her. Saying hi to Alicia here. Hi, Alicia. How are you? Thanks for joining us. So that's great information, Fidel, because there's a lot of more first-time home buyers concerned about buying than second or third-time home buyers. Especially when it comes to FHA home loan buyers. I'm gonna check on this chart here. I'm gonna try to share another chart, and we can discuss on that. Let me see if I can get to that chart. It's called the. Let me stop sharing here. Just give me 1 minute. Share screen. Okay, can you see that screen?
Yes.
Okay, so this screen here, we were talking earlier about mortgage rates are projected to come down. If you look at this chart, don't look at it as a lender. If I was a buyer, first-time home buyer, don't know a lot about going on, what does this chart tell me as a typical buyer, not a lender's perspective, from a buyer's perspective? What do you see over there?
I mean, if I didn't know anything really about loans, I see that as far as the top row, Fannie Mae, it's going to, I don't even know if I would know the acronyms to MBA or NAR. Obviously Wells Fargo is familiar, but I would be looking, okay, what are these, what are
the
these?
MBA is Mortgage Bankers Association, and NAR is National Association of Realtors.
Yeah. But so it shows, I guess, what the average is for all what they're determining or what they're predicting that the rates are heading, I guess, right?
Right. Well, so if I was looking at this chart as a buyer, not as a loan officer or a lender or broker or a realtor, if I was looking at this chart, I would say, oh my gosh, look at this. 2025 Q4 is going to drop to 5.98. I'm going to wait. That's the first thing I'll think about, right?
Right.
So what's the drawback? And I know you mentioned earlier, don't chase the rates or don't chase the prices, but as a typical buyer, I'm going to say, you know what? I can wait 6 months and save $200 a month by saving, so what's the drawback in thinking like that versus, hey, I got the money?
I'm sure it depends on whatever area you live in and what the market is there. I mean, where we are, waiting's going to hurt, I think, because, more people are going to be able to, as the rates get lower, more people are going to be able to qualify for that same home that you can buy today. And more competition, especially when there's, few homes on the market or not even the normal amount of homes on the market where we are, it will drive up the price of the home most of the time.
Right.
So that's where, you need to think, I guess, look at the big picture as far as how much competition do you want on the same home.
Right. Okay.
The more
All right.
competition, usually the more expensive it's going to be.
Right. Right. Here's another screen I want to share. That'll be the last screen that I'll share. But I think this is kind of important. Okay. Let's see. Can you see that?
Yes.
Okay. So I'll let you take us through this, but this is a typical mortgage interest rate and what the payment would be.
Mm-hmm.
If you had a chart like this, and like I said, thinking as a buyer, how does this make sense to you? Like if I buy a house, for example, at, let's say, the $400,000 house at 7.5%, the mortgage payment is $2,937, but the same house at 5.75 at the bottom is $2,451. What a big difference. So
no, absolutely.
I mean,
as a first-time home buyer, obviously, I think a lot of them that if they don't take the time to kind of learn and see how it works, or work with at least a professional in the business, a realtor and a lender team that can help them and discuss these things and go over these things. Because I believe you're correct. The first thing they're going to say is rates are going down. Let's wait. Let's wait till it gets to rock bottom, and then we'll go from there.
Yeah, but there's a chances that they may not go down. Something may happen, stock market crash,
Absolutely.
whatever, politics, I don't know. Anything can happen,
Yeah.
right? And then it may even go up or down. You don't know. Or
that's the thing is
right.
in the last couple of years, or it's been so hard to follow a trend. And,
Right.
and a lot of times what we, before we used to be able to look at a trend and say, okay, you know what, when people are buying homes and we get to that part and they even put an offer in and we're sitting there chatting about the interest rate, like, okay, where are we going to lock? Before we could look at certain economic data and say, you know what, it's trending down. I believe the market's going to, if we wait a day or two, not that we have a whole bunch of time, but we have a day or two to wait to see where the rates are going. We could kind of predict and say, look, there's a good chance that it's going to drop maybe a little bit in the next day or two. Maybe let's wait it out. But these days with the volatility, it is so hard. It's really not predictable.
Right.
I've had multiple times where I'm looking at something going, okay, for sure this is going to go down a little bit. The market's going to better tomorrow, and market opens up, something happened, war, whatever, and all of a sudden it goes up instead of down.
Right,
so
right.
it is so unpredictable for many people who've been in the business for longer than myself. It's so hard to predict these days.
Right. I just got a comment from Alicia. She's a good friend of ours. She's a realtor up I believe in the East Coast. Hopefully I'm not, or maybe in Oregon, but she's saying that even though many of our transactions are cash here, more buyers are in the market now than in months past. And even sellers are starting to consider a move, which is a good thing because a lot of the sellers have not been moving. I mentioned earlier, a lot of the sellers like myself have 3% interest rate. I'm not going anywhere with the 3% interest rate. I'm not going to sell my house at 3 and pay 5 or 6 or 7%. That'll double my mortgage rates. So that's a good point, Alicia, that you made, that, even though you have a lot of cash buyers, some sellers are now thinking about moving. I have a friend of mine, they just had a baby and they need a 3-bedroom house. So they're going to have to move. They've been hanging on. Now they got 2 kids in there and they have a 2-bedroom condo. They have to move. So I think it's a good thing that things are happening as far as rates are stabilized. From what I see, the rates have been, I would call, they've been coming down, which is good news for that typical buyer, right?
Yes.
Right. So
yeah. No, the market is starting to open up a little bit. I think we're, you would know better than me, but I from what I've seen, it looks like our inventory is growing a little bit because it's been very tight where we are for sure.
Right. Let me mention some stats because I know we've been kind of negative to the buyers in the sense rates have been high, rates have been high. But here's 3 stats I read that's good for the buyers. Number 1, nationwide, the inventory is up anywhere from 30 to 35% overall, and that's an average. It could be 10% in Orange County, it could be 50% in Florida, which it is. Florida is taking a bath right now. So the one thing is for the buyer is inventory has gone up. The second stat is that homes are taking longer to sell. That means you don't have to rush. Hey, see the house, write an offer, take your time, don't rush. And then the third thing is happening is that homes are selling pretty close to list price and they're not jumping like they used to. So that's good news for the buyers because now there's not a lot of multiple offers. It's taking longer to sell. There's more homes to choose from. And I think with the rates coming down, more homes will come on the market. Like Alicia mentioned, a lot of sellers are getting serious now about coming on the market. So I think that's good news. Even if the rates stay where they are, 6%, 6.5%, I think it's a good rate compared to 8%. We should see some more activity, right? I mean, what do you think as a lender? Where do you see lenders' home activity going based on interest rates?
No, I think you're right. Back, I want to say, was it? Well, that was maybe a little too far, but no, I think you're right. Now that there's starting to be homeowners that are looking to move, it's going to open up the market a little bit more for first time home buyers, a little more inventory, which is definitely going to help.
Right, right. Yeah, I mean, buyers need help, and any help you can get. I think if the rates go down, homes take longer to sell. Homes are are selling at or under list price. That's all good news for the buyers. Even at
Absolutely.
6.25, even at 6.2, even at 6.5. A lot of the buyers gave up because of multiple offers. And if there's a house for sale, let's say in Orange County, an average medium home price right now is a 1.2. They were selling at 1.3. And there were 10 offers. So I
Yep.
think with the slowdown, less competition, more choices, I think that's good news for the buyers, regardless of the interest rate.
I agree.
Yeah. So, one other thing I want to discuss here is when it comes to interest rates. Had a question on my earlier videos that I did a few weeks back. Is how does the fluctuating interest rates affect the home values in general? What do you think? Do they is it a direct impact or is it a long-term impact on homes or what?
Well, I mean, the interest rates. I don't know if they really affect the value of the home. I'm not sure if that's what you're asking.
That's what
I
they
mean,
ask. Yeah, I mean,
the home's
how
going to
fluctuating
appreciate.
interest rates? Yeah. Mhm.
Yeah, I think. I mean, the homes are going to appreciate depending on location. Uh, like the information you brought up before is the percentages that they're appreciating, but they have not gone down. I mean, I can only speak around our areas, but they definitely have not gone down. They maybe did not appreciate as much, but
Right.
definitely have not gone down in value.
Right. Right. Okay. Got
Yeah.
it. Okay. So here's a question also from one of the other videos I did, had nothing to do with this video, but it's kind of topic to that. What they asked was, should sellers wait for a potential improvement in interest rates or market conditions, or should they sell now and whatever the conditions are,
I
whatever
think that's
motive?
going to be up to the individual, whatever their need is. If they need to sell, I'm sure you get clients that say, you know what, hey, Mike, if you can get me 1.2 for my home, I'll move, right? And it may be realistic or maybe not so realistic, maybe close. I don't know, but everybody has different needs, and
Right.
like your friend that has a family that's growing, they need to find a bigger place for their family. So they have a need that's going to make them get off the fence and find something, as opposed to like yourself, who says I'm not going anywhere because my rates are low and
Yeah.
I don't have a direct need to do something right now.
Yeah. I'm pretty
Maybe
much that
something
I don't have
changes
to
down the
move.
road.
Right.
Mhm.
Yeah, absolutely. So I do see that a lot of people have to move. The example I was giving you earlier about that house that was for sale for 1.21 and they bought for 1.2 and now it's at 1.275. The buyers, I'm representing the buyers, it's a relocation from out of state and they have
Mhm.
to because of their job or whatever. So they are looking for a house. They need a bigger house. It's almost 3,700 square feet home in the city of Ontario, and they need a large house because it's a bigger family, or they need more rooms, work from the office, remote work, etc. So there's a need for them to move, so they're gonna move. Um, and they've been looking for a year now. They're finally ready to go.
Yeah,
So.
a lot of it at this time, I think it's more need than want.
Mhm.
Uh, and as far as first time homebuyers, I don't think it's necessarily a want. I believe it's, it should be a need to purchase a home. I mean, it's a great investment to get into. It helps you. You don't have to worry about rent, right? Your mortgage is going to be what it is. Whatever you got into, it's not going to change. You can do whatever you want to your home. You have that
Right.
flexibility as opposed to having to follow specific rules and not maybe allowed to paint it or customize it
Right.
the way you would want to do it.
Right.
So definite benefit to buying a home.
Right. Okay. There was a quote I saw earlier. I wanted to read it out. Let me see if I can find it quickly here. And it was a really nice quote. I wanted to read it regarding waiting and all that. Let me see if I can find it here. Actually, I don't see it here, so that's okay. We'll move on then. Oh, here it is. Yeah, it has to do with the timing. What should you do if you're a buyer or seller wanting to move? And it's about timing the market, getting the best price, getting the best rate or best terms and conditions. And what they're saying is, this is from Lending Tree. Jacob Chanel, senior economist at Lending Tree, says that timing the market is basically impossible. If you're always waiting for a perfect market conditions, you're going to be waiting forever. Buy now only if it's a good idea for you. I mean, this is a guy from Lending Tree saying that. I mean, how
No, I
impactful
agree.
is that? Yeah.
A lot of people chase the market, chase the rates, and it's never going to get where they want, for the most part. And like I said, it just goes back. If you can buy today and you're in the market to buy and you have the ability to buy, I would say buy. It's a great decision. If you have the ability to do it, do it.
Right.
If you can't and you have to wait, then you have to wait. But
Right.
if you have the ability and the desire, then get in the market.
Exactly. I have a simple formula for buying. You buy when it's the RWA, ready, willing, and able to buy. So I tell buyers, they ask me, when's a good time to buy? And I ask them, are you ready to buy? That means, hey, yes, I have to move. I've got a baby. I need a bigger house. Or my mom's sick now. She goes to the hospital. I have to get closer. So I have to move. So I'm ready. Are you willing to buy? Are you willing to make a commitment if you're renting and get, quote, stuck with a 30-year mortgage or a $3,000 a month payment? Are you willing to do that? And are you able to buy? That means, have you talked to Fidel and has he approved you for the loan and say, yes, you can buy a house for 400, 500, a million or whatever. So if those things work, ready, willing, and able, buy now, don't wait.
Right.
Remember the clocks I mentioned, the clock about your 30-year payment, start your clock now. Imagine if you've bought, I have friends who haven't bought, they've been waiting for 2 years. If they would have bought 2 years ago, and I tell them all the time, they're my, golf buddies. I tell them, you would have paid 24 payments right now out of your 30 times 12 payments. Out of the 360 payments, you would have paid 24 payments by now. And you would have appreciated 4% per year on average. That means you had an approximate 8% average increase. That's what I tell them. So when you are ready,
and a bigger home, probably more home anyway, more home than what you could buy today.
Absolutely, because the house they could buy $1 million in Anaheim Hills, where I'm at 2 years ago, is now an 850 home, which is a smaller home. So makes a big difference. Waiting is good, but when it comes to purchasing a home and waiting for no reason is not good. It costs you money. It costs your tax write-off. Imagine in Orange County, a 2 bedrooms, 2.5 bath home rental is about $2,500. So if you're paying $3,000 a month rent, if you waited 2 years, you just blew $72,000 in down payment money that you could have had if you were renting or whatever. So there's a lot of advantages of buying now. Sooner is better than later. Of course, you have to be like the quote says, buy now only if it's a good idea for you. Maybe some people cannot buy because, whatever.
Right.
But if you are ready, willing, and able to buy, don't chase the market. That's what I tell my buyers also. Of course, a lot of them don't listen to us, but hey, at least,
Yeah,
so.
no, it's, unfortunately that everyone makes the best decision they can for themselves, right?
Right.
But at least if they can make an educated decision and when we can show them historical charts and and just good examples. I have the same clients that super nice people, been looking for at least a couple of years. And I always try to make a point of remembering the first home that they buy and put it next to their file, or the
Right.
first home that they looked at that they wanted to buy. And that's the same thing that happens. It's like, hey, look, you could have bought this home for $1 million, and it was, back then, and now it's that much more. So now you can buy the house that was $850 at that time, and that's the house you're going to buy, right? For more than what you would have paid for it back then.
Yep.
So
Exactly.
I always do try to save that one home when I meet them. It's like, which house is it you're looking at on Zillow or whatever? Oh, this home. Okay, well, let's make a note of that home, and we're going to keep that home, and that's going to be our home that we're going to refer to down the road if they start taking 6 months, a year and a half. It's like we go back to that home and say, where's that home at today?
Right.
And that could have been your home. You could have bought that home. Where is it today? And what's the value of it today?
Exactly. Correct. Right. Right. Okay. So switching gears here, Fidel, if there was a typical buyer, what are the challenges that you have most of the time when it comes to first-time buyer homes? How can a buyer prepare to have the loan get through? What are some of the challenges that are common, and how could they have prevented just even before getting into the escrow or a transaction?
A lot of it would be financial education. There's people that get themselves in debt, and sometimes not knowing better. Not knowing how things work and how they're going to affect them buying a home. That debt. The more debt they have, obviously, the less home they're going to be able to buy, and sometimes they need to pay off some debt to qualify, or if something major occurred, some sort of credit issue that occurred, we may need to take care of that. If they, for whatever reason, something happened and they had a bankruptcy, then we need to work with that and get them in a position where they can buy, sooner rather than later, which maybe that's where FHA comes in, right? They're a little bit more flexible. They don't have to wait as long, but we come up with a plan, so the challenges is down payment money is usually the biggest challenge for first-time home buyers, and the debt that they're carrying. I think those two are the biggest challenges that they have.
So on the debt, when it comes to debt, I know there's student loans, there's car payments, there's credit card payments, there's medical bills. What are some of the debts that counts towards your loan, and what are some of the debts that don't count towards your loan, which may make a difference?
Sure. So as far as debts that count against your loan, it's going to be any type of installment payment, like an auto loan, student loans will, the credit cards, obviously those will, and it's going to be the payment, not necessarily the balance, but the payment is what they count against you. So, you may owe $10,000 on a credit card, and the payment's going to be, I don't know, $400, right? So the $400 is what they hit you with, not necessarily the balance on that card, but the payment. So we want to limit that as much as possible. I'm sorry. So that was debt. I'm sorry. Did you ask me?
Yeah, so I was just saying, how the debt impacts and what kind of debts impact.
So that is any of that. Now the items that don't impact it would be like your utility bill, gas bill, stuff like that. Those do not impact your mortgage qualifications.
Right.
So it has to be like an installment loan, credit card, revolving debt. Those are the things that do impact it. Some of the utility stuff like that, those do not.
Right. Okay. So I'm going to put you on a spot here, so just so that you understand. So a typical average home, USA, is around 430, somewhere around there. It could be 420, could be 440. So what would a typical, if I wanted to buy a $430,000 home, whether it's conventional or FHA, what kind of money should I be making? Or can you just take us through right off the top of your head? You don't have to calculate anything. Basically, what would it cost if I get an FHA loan or a low down payment loan? And what would be my payments on about a 430 home, typically? Just off the bat. Yeah, you can take your time to calculate.
So let's say, so if it's a $430,000 home, we're putting in,
with the current rate of whatever it is, 6.2,
Yeah.
6.5, whatever. Yeah. Just to give an idea, so.
So your payment's going to be somewhere around $2,500 a month, somewhere in there,
Somewhere in there.
for the principal and interest, right? But
Right.
then you're going to have also your property taxes, which is going to be it's going to be 1.25%. That's how it gets calculated. It's 1.25% of the sales price. So what do we say? $430,000 home times 1.25%. You're going to have almost $450 a month in property taxes that we have to take into consideration. And then also you're going to have your homeowners insurance. So depending on where you live, insurance is crazy right now, especially in California in certain places. So just depending on where you live, that could fluctuate a lot. But normally I would say on a $430,000 home, your monthly insurance payment is probably going to be somewhere around $110, $115 a month that we would add to the payment.
So 2,500 plus another 400 plus about 100. So let's say 3,000.
Yeah. Right.
Okay. So if I was to buy that home, what should be my quote income be to buy that?
So just kind of like a little rule of thumb, whatever your gross income is, you can purchase up to half of that usually. Okay. So if you're making $10,000 a month, you can afford a mortgage roughly around $5,000 a month. Okay. Just simple math. Now, depending on what your debt is, now this is where you have to remove the debt. So if you can qualify for $5,000, you're making $10,000, you get $5,000 towards the mortgage, right? Then it includes principal, interest, taxes, and insurance.
Right.
But you have a $500 a month car payment. Now you're down to $4,500 for your mortgage, right?
Right.
And any other debt. So you have another credit card debt for $100 a month, drops it down, that much more. So that's how you can back down or back into just really rough number, but at least it gives you an idea as to what your maximum payment could be that you would qualify for.
So I was under the impression, and I tell a lot of my buyers for all these years, and I could be wrong. I tell them that usually your principal interest, your house payment should be at least 1/3 your gross income. That's what I used to tell them. Not counting your cars and your medical bills and things. Of course, it's more now, but I would say roughly, if you're making $10,000, then I would say you could afford a $3,000 house.
Yeah, I mean that's more conservative, definitely. So more ideal, obviously. The lower the debt to income ratio, the better, the easier you can make your payment. But they do allow you to go up to conventional financing lets you go to 50% of your debt to income, right? So if you have zero debt and you're making $10,000, you can go up $5,000 a month mortgage.
Yeah, you have no car payment, you have no credit card, you have no medical or other installment payments, no solar
or revolving debts, then you technically could go half of your income, your gross income. And it's not net, it's gross income.
Right. And I wanted to add something to that. Two things through the PITI, which is the principal, interest, tax, and insurance, your car payments, your student loans. Two things that we need to add. In California, I don't know about other states. In California, if you buy a brand new house, you got to have solar, whether it's a brand new builder or you're constructing a new home. So now you got additional cost, $200, $300, $400 a month for solar, because I just sold 2 homes, brand new homes, and the buyers had to pay for the solar on top of that. That's a California law. So you have to add solar if you're buying a brand new purchase. So add another, on average, $300.
It's going to be an installment payment.
But that goes to your debt ratio, right?
Correct.
And the second thing is a lot of the newer homes, newer communities, if it's a condo, you have HOA. Does the HOA go towards your debt or it's not?
It does. It gets counted. So it's PITIA is what the acronym is. So it's principal, interest, taxes, insurance, and any sort of assessments. So if there's a HOA or anything in addition to that comes with the home, then we have to include that.
Right. Yeah, because a lot of the newer homes, a lot of people buy brand new homes. Then you have your solar, at least in California. I don't know about that other states. Then you have a HOA. Some of them have 2 HOAs. Then they have those what we call mellow roofs and assessment tax and school board taxes. And And it can add up, and a lot of the buyers don't know about this, and that's why I wanted to talk about it. Hey, make sure you ask your lender or the builder, or even if you're buying a 2 or 3 year old home that you're taking over, you have this additional cost that'll knock out your purchasing power from 3,000 to maybe 2,200, because now you got solar and HOA. That's $500 right there.
Yeah, no, and even property taxes. So, if you go into somewhere in Riverside County or San Bernardino County, some of those tax rates, after you add those additional taxes, I mean, you're looking at 1.72% taxes,
Yeah.
property taxes.
Yeah, Temescal Valley, all
that's-
those homes. Yeah, Temescal Valley. Yeah, I sold a couple of homes last year in Irvine near the Portola Hills,
Mhm.
and those tax rates, our normal tax rate in Orange County is 1.1. Over there, it was 1.7.
Yep.
On $1 million home, if it
Mhm.
was just 1.1, that's almost 12,000 in taxes. At
Mhm.
1.7, that's almost 19,000 in taxes. That's
Mhm.
every year after year, until you own the home. That's a lot of money, a big chunk of your money.
Yeah.
Because you're paying for the library and the schools and the parks and the community and all that. So you have 1 and 2. Some of them have 3 association fees. I've shown homes where there's 3 association fees.
Mhm.
One is a monthly fee, one is a quarterly fee, and one is semi-annual or annual fees. It's ridiculous. It's just too much.
Yeah.
And
No,
the
and
vendors look
that,
at that, right? Yeah.
yeah, and again, that's why you need a professional to help you, because a lot of people don't realize that those taxes are there, and that does affect their buying power.
Exactly. I remember about 10 years ago, my niece called me up and said, "Hey, uncle, I want to see this house in Irvine."
Mhm.
And I said, "Well, you can't afford it." I told her in a nice way. The condo at that time was for 640. It was
Mhm.
a brand new, I believe it's called the Marquee. At that time, the association was $1,200 a month.
Yeah.
Just the HOA, $1,200 a month. I bet you now, after 10 years, it's probably $1,700 a month just in HOA fees.
Yep.
It's
Well, and
ridiculous.
that's the thing is, as the community ages, then the HOA's fees will go up as well.
Right.
So,
Right. Yeah, exactly.
because
All
there's going
right.
to be deferred maintenance.
Right. Well, while we're talking about it, I never put it out there, but if you have any comments, whether you're watching live and we're almost going to end the show, or if you're watching a recording, and if you're still watching, I really want to thank you. Please make comments, or if you have any question, we will answer after the recording is over. It'll be on my YouTube channel. So do put some comments. And if you're looking to talk to a lender, if you're in Orange County, Riverside area, I'll be putting Fidel's number in my descriptions, or let me know and I'll have Fidel call you or email you. Or nationwide, between me and Fidel, we have a nationwide network of lenders and realtors. So if you're looking for something local, we can refer you to one. So I'll have a link in my descriptions you can take a look at, so feel free to contact us. So in closing, Fidel, do you have some any good nuggets you want to leave for our viewers, whether it's interest rate or buying advice or anything?
You know what? Speak with a professional. So call Mike. He'll set you straight.
Okay. Yeah. I always tell them, talk to a professional. You don't have to buy, right? If you're just
Correct.
thinking about buying, hey, Fidel, I'm not ready to buy. I'm going to buy in 3 years. Can I talk to Fidel? Absolutely. Get to know
Yep.
what it's going to take to buy a house. If you have bad credit, Fidel or any other lender or realtor will help you clean up the credit or help you build credit, help you build down payment. So talk to them even if you're 2-3 years away.
At least build a plan, right? At least now you
Have
know
a
where
plan
you
and
are
start saving.
and what you need to do to get to where you want to be.
Right. One thing I will tell you is that if you're a buyer, don't wait for the perfect time. There is no perfect time. I always say to my buyers, you know what? When you get married, there's no perfect wife. They're perfect husbands, but not. No, I'm just kidding. So don't wait for a perfect wife. It ain't out there. If you find 8 or 9 or 7, 8, 9, go for it. Same thing with the house and interest rates. If you find a 7, 8, 9 interest rate, 7, 8, 9 purchase price, 7, 8, 9 location, 7, 8, 9 floor plan, go for it. There is no such thing as a perfect home, perfect rate, perfect payment. It's just not out there. So that's my 2 cents. I'll leave the last word for you, Fidel. So
Buy sooner than later. If you can qualify, buy.
bye. Okay, get the clock going.
Yep.
All right.
Absolutely.
Hey, Fidel, thank you so much. You gave a lot of information to our buyers. I'm sure they can use it. If you want any resources, any charts, any websites, whether from Fidel or myself, anywhere in the USA, hit us up, direct messages. Thank you so much. We do have this live at 2 o'clock on Mondays. And my end the conclusion is sell smart so you gain more. Thanks for watching. Thanks, Fidel.
Thank you.
Okay, bye-bye.